Okay, good morning everyone. I'm going to kick off this TPM webinar now, make sure that we make the best possible use of our time. Firstly, thank you all for attending. It does seem somewhat remarkable that a mere, sort of 7 months ago, I think, we were all sitting in Clifton's face-to-face discussing this. Now a pandemic's occurred and we're all doing this by Zoom, but really appreciate your willingness to make use of the technology as we all are in these frankly unprecedented times. I'm going to deliver a very short introduction, and then JP will introduce the broader session, talk about exactly what we're taking you through and how we're going to make sure that we take the opportunity to answer your questions and when we'll do that. Obviously, given the use of technology, it's going to be slightly different than just putting hands up in a venue. That's to be expected. I suspect most of you, like me, have been involved in very large Zoom meetings over the last couple of weeks, and they are quite difficult to run. So please bear with us, and please use the Q&A function that we have at the bottom of the screen. Particularly, please also make sure that you give feedback if you're having any audio problems, struggling to hear anyone, or want people to slow down or similar. I note that we already have one question in there from Marianne Mitchell, so thank you, Marianne, for making use of the function and confirming with us that it does work. I'm not going to cover a whole lot of the ground again that we've previously covered in these types of TPM presentations, except to reiterate really 2 points that I've made at every one of these engagements and continue to be very strongly the case from my perspective. Firstly, everything we have seen and heard in this TPM exercise continues to reinforce that there is a need for change in the transmission pricing methodology. There is still some debate as to what the best way of changing is, indeed what the best timing for change is, but I've yet to hear anyone make the case that the status quo is satisfactory. I also think the point about consensus is still a difficult one. I do not think we will ever achieve complete consensus on this, albeit that there are some particular points of TPM reform that some views do seem to have coalesced around, which is obviously helpful, and it's been really useful since we last had one of these large presentations to have had the oral submissions to our board in December. We thank everyone for their time and effort on that. Turning to the CBA in particular, CBA is obviously one of the many inputs that the board considers when it makes a final decision in relation to whether or not to change the TPM guidelines. It's an important input, but it is just that. And inevitably, the CBA is able to measure some things quantitatively very well, and it struggles to measure some other things quantitatively. So it is not a complete answer on the costs and benefits due to the lack of quantification of some things, but it is a good guide and we think it's important. I would like to really acknowledge the value that we have received from our engagement with you on the cost benefit analysis. As you will see from the paper that we recently put out, we have received significant feedback on it and we've taken account of that feedback. We believe it has improved the quality of the cost benefit analysis, and that is now substantially revised. We remain confident that the core of the CBA is robust and is a useful input to board decision making. One of the things that we promised is that we would come back to you in relation to the CBA and explain to you how we took account of your feedback and what that's led to in terms of the conclusions that the Electricity Authority is drawing. The paper that we've published and this webinar, which is both an opportunity for us to explain what we've done and take questions and answers, is fulfilling that promise to come back to you. The approach we're taking with questions is to use the written question and answer function sitting on the bottom of the Zoom menu. So if you click on that, you'll be able to send a question through to us. We will be triaging those questions as the meeting goes by. It's unclear to us at this point in time how many questions we'll get, so whether or not we'll be able to answer all of them. To the extent we need to make choices, we will make those choices based on both a representative sample of the questions and questions that we think are particularly relevant. Should you be concerned that your question hasn't been answered, we are open to you emailing us at the usual TPM email address, which is tpm@ea.govt.nz, and we will endeavour to answer your questions and publish them on our website, should there be further ones that come through there. We will be recording this session and publishing it. So while of course you're welcome to take as many notes as you'd like to, you will have access to the full session through our website. There is lots to cover today, so we will be working through it at some pace. While we will endeavour to cover most of the material, both John and Philip will make judgment calls. I say that in that I think it's important that we don't take a formulaic approach to this and do a complete page turn, ensuring that every word is read from. Someone suggested to me after one of our previous sessions that because we hadn't covered one of the slides, there was some concern about that actually that was a deliberate judgment. The slides were there to help with discussion rather than needing to be covered formulaically by everyone. So John and Philip will absolutely make some judgments, and that's the right thing to do. Finally, I think it's important to reflect back to you once again that what you're hearing today are Electricity Authority staff views. We have not put a proposed final version of new TPM guidelines to our board for decision. They still have yet to make any decisions and will continue to run through that process robustly. We continue to expect that the board will make its decisions on TPM guidelines in this quarter. But the process is always with the board to decide where they go. So I'm going to finish the intro at that point and hand you over to JP. I will be listening with interest as all of you are, and I'll talk to you again when we close the session at 12:30.
Thank you, Rob, and good morning, everybody. I'll start taking you through some of the presentation material. Rob has already spoken to you about the purpose and how broad outline this presentation will work, so I won't go over that again. But here's the agenda for the morning, and as Rob mentioned, we've got to take quite a structured approach, and we'll take the presentation in blocks, try and keep to the times, and at the end of each block there will be an opportunity for questions and answers. So I'll try to keep us to time and select the questions that I think are most representative or relevant to the audience. I'll then read out the question to make sure everybody has heard that, and then ask someone to provide an answer. There may be instances when it might be helpful for one of the audience members to clarify their question, and in that case I will ask Justin from the Cliftons to unmute you, and we'll go from there. So in this next segment we talk about the revised CBA results and to set up the topics that we've prepared for the rest of the webinar, focusing on the key changes and explain the background to those. Yeah, the other point I probably should raise at this time is that, of course, a cost-benefit analysis is not a precise exercise, but seeks to capture the sign and the order of the magnitude of costs and benefits of a proposal compared to a baseline and any alternatives. But it also is the case that we're talking about what we've modeled, and not all the costs and benefits are able to be quantified in any reasonable sense, and these also need to be considered. And then finally, I guess more generally, a CBA is not a decision or substitute for a decision. It's just an aid to support decision making. So in this slide, it highlights the headline result, which is that as a result of the revisions, having considered all feedback on the 2019 CBA, The headline result is now 1.3 billion, which is down from 2.7 billion within the ranges that you can see on the slide. So the revised results are positive and material, and it continues to indicate the proposal would be for the long-term benefit of consumers. And those key benefits come from removing distortionary effects of the current charges, which as a result increases electricity demand at peak, reduces incentives to take actions to avoid and shift charges, and reduces the distortions on generation investment options. And the table highlights the areas where we will where the main revisions have been. So grid use efficiencies, see those on the screen. We'll go through each of those in turn, and at each point give you an opportunity to ask questions. But before we do that, I wanted to deal with 4 framework issues that were raised in submissions before we hand over to John in the first instance. So some submissions thought that the CBA did not assess the authority's proposal because it paid insufficient attention to the effects of the benefit-based charge. We worked through those arguments, but do not agree that we've ignored those effects. Just briefly, under the baseline, the model allocates the interconnection costs to consumers based on shares of peak demand as a proxy for the RCPD. For the proposal, these costs are allocated differently based on shares of loss and constraint access, which would be a proxy for the benefits from economic investments, and based on shares of peak demand as a proxy for benefits from reliability investments. And then in addition, there's also a top-down impact of benefit-based charges on generation and load investment decisions that's taken into account. So if anything, the CBA is conservative because the interconnection charges still feed into a per megawatt hour price at the GXP. So in effect, the benefit-based charge has an overstated repressive effect on demand. Second point there on the slide, some submissions thought that the CBA did not model the relevant baseline because the RCPD charge is obviously too high and distorts decisions, and that this and any other aspects could be changed within the current guidelines. Our view is that the existing TPM is the most obvious baseline to use because it resulted from implementing the current guidelines. It is, of course, possible for an operational review that transpire could reduce the strength of the RCPD signal, but this would not address the fundamental distortions from that charge, and there's been no suggestion of such an extensive operational review being carried out. And that's, despite the significant increase in strength of that signal over the last decade or so. The CBA does, of course, include what we call the alternative to the proposal. And in that alternative, we significantly reduce the strength of the RCPD signal by increasing the number of training periods used to calculate interconnection charge. But of course, this is just one option between 100, which is now, and all trading periods, 70,520 periods in a trading year. Then on the third point, there were some questions about whether the time frame was useful, and in particular, because many of the benefits do not occur until some years out, how much weight could you place on those benefits? It seems entirely reasonable to use a 30-year time frame, given the investments in assets are well over, have lives of well over 30 years. There are, of course, no hard and fast rules for specifying the time frame for CBA, but it's standard in infrastructure CBAs to consider the effects of an infrastructure investment over the life of the asset. And of course, discounting of future values helps address some of that weighting of future values, as does the sensitivity analysis, which we'll go through in a bit more detail later. And discounting of course means that there's little practical use in measuring costs and benefits beyond 30 years because of the effect of discounting costs and benefits means that any effects after 30 years will have a trivial effect on the overall CBA in any case. Having said all that, the results do not rely on having a 30-year evaluation period. A short evaluation period still shows net benefits from the proposal. And then finally, on this slide, I wanted to raise, want to talk about concern raised by a number of submissions, quite a number, that the cost of any distribution network investment brought forward would need to be included. Now, the CBA does exclude the cost of additional distribution investments, but it also excludes the benefits associated with any additional distribution investment. And we're very comfortable with that approach. So, the way we look at it is that if some distribution investment is necessary to accommodate any additional peak demand under the proposal, then we think that the value that consumers place on that investment will exceed the cost of this investment, or at least be equal to it. And that follows from our assumption that investment in distribution networks would be efficient and that consumers face the cost of distribution services they use. Now, the decision to exclude distribution costs and benefits and to analyze costs and benefits at the GXP level was also influenced by empirical considerations, which is that there is no readily available time of use consumption data by ICP, and that is a critical issue in assessing the effects of transmission pricing in New Zealand, because demand and supply prices vary by time of use. So by stopping our analysis at the GXP, we don't incorrectly exclude the costs of any additional distribution investment, because we also are at the same time excluding the benefits associated with the additional distribution investment. So it's an equal treatment. Now, that puts us on time of a timetable, and if there's any questions at this point on those matters, we've got some time for that now before we head to the next component of the presentation. So I see Marianne Mitchell has asked a question, which I propose that we deal with a bit later on when we talk about alternative scenarios. So we've got one question here from Duncan Mills from Vector, which is, given the world is fast moving to discussing managing the peak, not meeting the peak, what are the benefits of new EDB investments to peak? Anybody that particularly wants to run with that, John or Philip? Or perhaps we want a clarification? Are you answering that, John?
I think some clarification would probably be helpful.
Okay, Justin, would you be able to ask, unmute Duncan so that he can give some clarification, please?
Hi, it's Mark here from Vector, not actually Duncan. I must be signing in on Duncan's things. Apologies for that. I'm just genuinely curious because, you know, we're doing our best to manage the peak, not meet the peak. But I think what I'm taking from your preso is we may well be called upon to do new investment to meet new peaks, and that there's an implicit benefit into that. But, you know, honestly, the world, these are pipes that are big enough, and the smarts are now in place to manage the peak. So I just didn't quite get where we're going on terms of further serving the peak. You know, that day's gone.
Okay, I guess the answer to that, that may well be the case, but if, and it may be all kinds of ways by which demand may be managed, for example, in response to price signals. But if consumers want to consume at peak and a distributor needs to meet that by additional investment, the only point that we're making is that those investments would be efficient in terms of compared to alternatives to meeting that demand, and that consumers would be willing to pay for that. And that's the only point we're making in this case. All right, any other further questions on this? Otherwise, we might as well move to the next component. All right, I think we move to the next. Well, there's actually a couple of additional questions. So, Ferdinand Kruger asks, by excluding both benefits and costs for distributors' investments, that might sound fair on average, but could it not distort costs and benefits in specific cases? And the TPM has various specific impacts in specific cases. We do not pay average prices in specific locations. Any thoughts, John, on that?
Oh, look, I think that's a good observation. So those sorts of distributional effects, I can imagine that they will have. But the perspective of the CBA is the balance of effect across everyone. So to the extent that there's unders and overs, it is the average that ends up mattering in CBA.
All right, and then a final question before we move to the next one, which is from Rebecca Osborne. Networks are required to provide an essential critical lifeline service to community expectations. How does the model account for the reality that network investments therefore don't always have benefits that reasonably exceed costs? I'm not sure if that's part of this topic, but other than to say that the model does consider both reliability investments and so security of access and economic investments. Anything you want to add to that, John?
No.
Okie dokie. Now let's move on to the next component then, if you're ready, John.
All right. Good. Okay. Kia ora. So I'm going to go through some of the key drivers of the changes in the CBA results. So this is where we've responded and taken into account submissions and adapted the CBA. I have to say there were some really thoughtful quality submissions made, and they were very useful. I think nowhere more so is that the case than in some of the sort of detailed analysis that was around investment in utility scale batteries, and a role that was the investment in batteries was having in the CBA. It's probably worth noting at the outset that the batteries had sort of two related effects in the CBA. One was the observation of benefits of avoiding inefficient investment in utility scale batteries to avoid peak demand charge. But also batteries affected a measurement of transmission costs brought forward and affected the amount of generation investment required under our baseline and so on. So it's a sort of multifaceted thing, certainly in the previous CBA. And the observations that came through, in summary, because there was a lot of detail there, were that essentially there was too much utility scale battery investment in the baseline, because the modelling had assumed a constant marginal profitability of battery investment, even as battery investment was increasing. There was also a discussion about the fact that we had ignored one of the reasons why there was only a constant marginal profitability and not a declining marginal profitability of investment in batteries was because the analysis was ignoring the extent of constraints that exist on shifting load to avoid peak demand charges. So the risk that you have of creating new demand peaks. Some of the other comments were that we excluded some of the benefits from battery investment beyond price arbitrage and peak demand charge avoidance. And there were also some comments around costs and whether or not our assumptions on costs were sufficient and in particular high enough that the capital costs, connection costs, operating costs of installing batteries were perhaps understated, and that the classic in the case of battery investments, when one speculates about what the price will be in say 10 years time, whether or not that was sufficiently or whether that was reasonable, and whether or not the battery capital cost was understated into the future. And then when we saw in at least one submission, the advantage of getting down to having a look at some of the detail of, or detailed data, detailed demand profiles of charging and, that could support charging and discharging of batteries in a profitable way. We hadn't gone into, trading period by trading period analysis. And there was a criticism, and the feedback is something that we sought to rectify. So, the summary of the changes made, a high level, and I'll step through them in a little bit more detail after this. We've changed the rate of battery decline somewhat, so in the 2019 CBA there was a fixed rate of cost decline. We've changed that so that in approximate terms, the rate of decline in battery costs starts out quite rapid at around 11% per annum, and then subsequently eases off at sort of 2% per annum. The second thing we've done is looking at more recent estimates of sort of current capital costs of investment in batteries. We've revised up the sort of base case value of what a battery costs and the sort of all-inclusive installation cost gone up 20% to $1 million per megawatt, just as an indicative figure. Granted, those values change somewhat depending on how large scale the investment is and depending on the energy to power ratio of the battery, but it's a nice simple benchmark there of $1 million per megawatt. And there's a little bit of criticism from the feedback from submissions on the 2019 CBA around the optimality of the battery investment as it was modelled with a simplified investment rule. We've stepped back and ensured that the battery investment decisions being made in the modelling are based around expected earnings, and those expected earnings from battery investment are built up from a model of optimal daily charging and discharging of batteries using 3 years of demand and prices at trading period level by transmission pricing region and including transmission charges. We've, on top of that, allowed for a 2% forecast inaccuracy in terms of the number of trading periods, or sorry, in terms of the demand level that would kick you into a peak demand period. So we build uncertainty into that modelling as well. And then we subsequently make an adjustment for any effects that the scale of battery investment can actually have on wholesale prices and therefore affecting the profitability of the operation of batteries. So in terms of revisiting the capital costs of batteries, say there's quite a wide range of views around how much batteries can cost in terms of operating costs, connection costs, capital costs for the battery itself. We reviewed a range of possible parameter values for calibrating a cost function using a whole series of studies. Those studies all had extremely wide ranges of views, both on the current costs of batteries, but also on rates of decline. One of the things which is, can be a bit of an issue when you're looking at a very large number of studies is that some have very little information about how numbers are actually arrived at. Often, for example, they're sort of crowdsourced forecasts and the numbers themselves have, uncertain robustness. What we did do is settle on one more recent, quite well documented study that was published in the journal Joule in 2019 by a number of researchers from Imperial College, called Projecting the Future Levelized Cost of Electricity Storage and Technologies. So our cost function is based around the parameters and information in that particular study. So we have, in approximate terms, so the average of our new function, which is depicted in the slide here, got a annual growth rate of decline in costs around 4.85%. The 2019 CBA had a base case assumption of 7% constant rate of decline per annum in the cost of batteries. Of that average 4.85 over the CBA horizon is actually the initial period in which rapid uptake of batteries is expected to continue to drive costs down quite rapidly. That's out to sort of 2030, where we've got a 9% per annum rate of decline, which is in fact faster than the rate of decline in the 2019 CBA. And thereafter, the rate of decline averages around 3% per annum, which is substantially slower than in the 2019 CBA. And just to be clear, these costs that we've included in here are capital costs, connection costs, fixed annual operating costs, and maintenance costs. So separately from thinking about costs is a question about how batteries would operate given price signals in the market, and how often they would charge and discharge, and how profitable they could be from a purely operating point of view. And to look into that, we've pulled in a model of optimal dispatch. We adapted this model from a paper by that was published in Nature Energy in 2019 that looked at the economics and technological aspects of using batteries for energy storage, for grid application, energy arbitrage, and so forth. Taking that model, we then take prices and volumes as given over the past 3 years. We did consider samples of up to 10 years to test the model. This can become a little bit prohibitive in terms of running scenarios. So we grabbed a sample of 3 years of trading period data. We run the model differently the same way, but over the 4 different transmission pricing regions. And the model essentially optimizes the timing and volumes of charging and discharging a battery subject to technological constraint. And because we're dealing with a situation in which in the baseline there's a peak demand charge, we add additional constraints that include an upper bound on charging, which is 0, where forecast regional grid export is within 2% of minimum of RCPD volumes and trading RCPD trading periods. We put an upper bound on discharging, which is also held at 0, where the forecast regional grid export is likely to be a peak period and within some tolerance of that minimum RCPD. And this 2% sort of indicates, I think as noted in the slide, some degree of forecast error. And so not being sure before the fact, because all the numbers haven't come out exactly when a peak demand period is going to fall within the RCPD 100. The 2% number might seem a little bit small. It was informed by typical peak load forecasting errors. It's not in and of itself an especially inconsequential difference. If you, on average, so putting this threshold in, the effect of it will vary across different transmission pricing zones, depending on how flat or how relatively flat their load curves, load duration curves are through that peak portion of the curve. But on average, it essentially adds an extra 300 trading periods on top of the 100 actual peak periods. So that in the model is treating typically 400 trading periods as being potentially an RCPD period in which the constraints on battery operation come into effect. So I guess the upshot of taking this particular approach is that the modelling is significantly more finely tuned to issues around variations in demand from period to period and prices from period to period and across different geographic areas. And you can see that to some extent in the chart that we've put here, which shows significant spread in the use of batteries on any given day, depending on market conditions and location. This figure here shows the distribution of daily charging of batteries that comes out of the model for a 1 megawatt hour battery by transmission pricing zone. So once we've modeled the sort of optimized operation of the batteries, the results of that trading period model then get aggregated back to construct relationships between earnings that you could make off a model, off a battery, and the scale of investment and transmission charges by pricing zone. So this relationship and earnings function is what goes into the CBA model. And before we finalize that function, we do an ex post adjustment to the earnings that comes out of the trading period battery cycling model, to account for the fact that large scale demand changes can have on energy prices and hence on earnings. That is to say that, for example, if you're charging a great deal, if you have very large scale batteries, battery investment, then charging a great deal will lift prices, will lift demand off peak, and consequently may increase energy prices. So we just wanted to add this particular adjustment, particularly to account for another reason as to why you might get diminishing marginal returns on batteries. So to do that, I'll make this adjustment, we've used an elasticity equal to 2. It's a simplified way of representing this relationship. Now, that is to say an elasticity of 2. What I mean is we look at the percentage change in demand that occurs from, say, 500 megawatts worth of batteries all charging up at off peak. It gives you a percentage change in demand. We multiply that by 2, and that then gives us the percentage change in prices. And because we do that, because we do that ex post, after the model's already been optimized, what you can see you've got here is a table of the modeled annual earnings per megawatt. And you can see at the bottom, just looking at the bottom there, where you've got large amounts of batteries, you're actually getting negative earnings. Now, clearly no one would actually be operating under those conditions if they knew what these demand response values would actually be. It's somewhat academic in the sense that in the modeling you don't, in any given particular area, start to drive to install 500 megawatts of batteries anyway, but just to highlight that that's why those negative numbers are in there. And how we arrived at the 2 elasticity to get this price effect adjustment in was to do quite a simple linear model of wholesale price as a function of volumes in the market, or more to the point, changes in wholesale prices as a function of volumes. We fitted a sort of simple third order polynomial, and we also accounted for year specific supply conditions by having annual average prices, having what we call year fixed effects to take into account that some years just have higher prices. And this was all fitted on a model of 10 years of wholesale price and volume data. So what ends up falling out in terms of the detailed trading period modeling and then looking at the earnings that come out the other end, some of the overall result was probably highly predictable, which is to say that earnings from batteries is highest in areas that have the peakiest loads. So overall, when you're looking at a transmission pricing region, so a wide region, you've got situations where the lower South Island tends to have substantially flatter load, and that ultimately gives them less opportunity. It's less profitable to install and run a battery as compared to the Upper North Island or the Lower North Island, which tend to have the peakier loads. One of the things which fell out, which is a little bit more, I guess, not necessarily quite so obvious coming into the analysis, is that interestingly, the presence of an RCPD charge can actually, while it incentivizes the installation of batteries to avoid charges to one degree or another, the RCPD charge actually can constrain the investment of batteries for price arbitrage or energy arbitrage reasons, because you get, periods in which, during peak periods is not always the time in which wholesale energy prices are at their highest. So the opportunity is there to arbitrage by charging a battery perhaps during a peak and discharging at the peak or at a nearby shoulder. That actually gives you, makes the battery operation profitable. But of course, if you step into those peak periods while charging, then you increase your exposure for those RCPD charges. So the overall effects, just summarized briefly in these charts of changing the approach. The chart on the left, where we've got battery investment charted in both the consultation paper results and the revised results, both charted on the same axis. So you can see the substantial difference between the two methods. So we overall get a substantial decline in the amount of batteries actually invested with the revised approach. However, the chart on the right, where we've got the revision measured on the right-hand axis and the previous consultation paper on the left-hand axis, you can see that battery investment's actually occurring a little sooner in the revised modelling. So the more detailed modelling is suggesting that in small amounts, and only in small amounts, that batteries are more profitable in the baseline than we previously modelled. So that's the summary of where we went to and what we ended up with. If anyone has any questions.
Yes, there's one question at this point from John Cooley, John, which is, can you outline what assumptions you have used as to the impact of batteries on peak, shoulder and off-peak net demand? What efficiency is used?
I haven't got, unfortunately, being screen constrained. I haven't got the numbers in front of me. So those, yeah, I can have a look later when I'm less screen constrained. What I can say is that what we did do was take the battery operation modelling, the trading period modelling, and backed out the typical percentage changes in demand by time of use from that modelling, and then used those values to calibrate these effects. In terms of when you run if you discharge at peak, there'll be some degree of, there'll still be some degree of charging at peak too, acknowledging that. So when we define peak as not necessarily explicitly the 100 RCPD peaks, but broader than that, you might be charging a bit around that peak, and the overall net effect of the charge and discharge is what we've taken into the impacts on demand into the actual grid use modelling.
Okay, so we might come back with details later on, John. There's another one from Ferdinand Kruger. You apparently focused on price arbitrage to quantify the net benefits of batteries. How does this relate to the possible use of batteries by EDBs to delay or even prevent capital investments in lines and substations?
Yeah, right. So it doesn't relate to that in the sense that the analysis that's done doesn't assess whether or not it's valuable for people to install batteries for other reasons. It's focusing only on the margin in which there's an incentive created from a peak demand charge to invest in batteries. So it's without prejudice to the use of batteries for other reasons. We have noted, I think, previously that if, to the extent that batteries are offering other services but not yet profitable, but an RCVD charge is going to make them kick them over the line so that they are installed, that's still going to be an inefficiency, and it's likely to mean that you'd actually get, even larger battery investment early that was actually too early, and unnecessarily early, because all it was doing was capturing that additional incentive that's created by the RCVD charge.
Right, and a question from John Cooley. Do you account for the value of future price arbitrage value of batteries in providing backup to the increasing wind supply variability within the modeled time zones?
No. So the calibration of these earnings functions is backward looking.
Okie dokie. Any last questions on the battery side? I can see there's a couple of other questions. Actually, whilst we've got opportunity, we might answer the question posed by Eli Grace Webb, which is that benefits from distribution investments are not factored into the CBA. However, if the driver for that investment is additional peak demand resulting from TPM proposal, then are distribution-related benefits not factored into the consumer surplus estimate. In other words, consumer surplus is contingent on additional distribution investments. For example, in some cases, for example, where there are capacity constraints. And you may want to add to this, John, but I think the answer to that is, of course, we've thought about this, is that the consumer surplus or the distributional effects are, the effects are not evaluated at the ICP level or retail level, they're evaluated at the GXP level. So that to the extent that there are supply constraints that impose costs, they are downstream, and relieving those would both have costs and benefits. But they're all downstream from what we evaluate. Would you want to add anything to that, John?
Well, I think, yeah, I think it's always a bit low to be technocratic. We're not necessary, but the convention would be that if much of what Eli's raised would hinges on whether or not the demand relationships that are being used to examine consumer demand response are estimated on a market in which those costs and benefits are sort of already existing or baked in. So in other words, you can conceptualize a pure GXP level demand function that's completely unrelated to distribution demand or costs and benefits, prices and demand down on the distribution side of things. And if you have such a demand curve, then you would generally have to go and look at what the actions and costs and benefits in the, let's say, principal market, that upstream market, are going to have on the downstream market. But if you've estimated a demand curve which actually is essentially showing you it has baked in the effect of when demand goes up on a distribution network, prices go up and people are judging the costs and benefits of those effects, then it's the case that your demand curve's already taking into account those the balance of cost and benefits in that downstream market, essentially. So it empirically nets out is what ends up occurring. So in which case, you're not biasing your consumer welfare benefits, right? Is essentially what happens. Another way of saying that is if you could isolate the purely transmission component of it, then the benefits would be larger, essentially. And that's the sort of orthodox approach to these things in CBAs.
Okay, thanks for that. Thanks for those questions, people. That's really helpful. Hopefully it's working for you okay. And apologies for some noise pollution at the moment, which is the realities of level 4/level 3 working in an open plan environment. If only I'd thought about that 10 years ago. Anyway, John, if you want to take us through to the next topic, and we go from there.
Okay, so in another substantial area of feedback that came through were questions in how the modelling was dealing with generation investment. So people questioned how it was that generation investment was occurring in the modelling, yet wholesale electricity prices were falling. When you did have increased electricity demand, you had the lower wholesale electricity prices. Questions about generation investment occurring and perhaps the revenue that was coming from that being inadequate to cover costs, so not profitable, and inadequate accounting for suppression of, I guess as part of all of this, suppression of wholesale electricity prices caused by new generation investment, which is to say it's a comment principally on what it was the model thought was in the minds of the investors when the investment was being made, such that why would they invest if prices, large amounts of prices were then going to be suppressed substantially subsequently. And so it would be fair to characterize the previous framework or investment rules that were being used as being very liberal, in which a large amount of generation investment was taking place. So in terms of the changes that we made, thinking about reconsidering the liberality of the investment rule, the first change that was made was to include in a generator's or an investor's decision to invest in new generation, to include historical average offers and use those offer curves, and then base the investment decision based on what the price would be given current demand if the investor was to invest in a new plant and change the offer curve. So and therefore depress prices. So we built that into the rule, into the investment rule. So that's what that picture on the slide is demonstrating. Sort of reasonably simple concept that in the modelling we might have the blue curve as the sort of typical market offers by trading period, a different curve for each trading period, time of use. And the investor is considering, if they put their capacity in, how that curve will shift and therefore result with the given demand in potentially a lower price. And each potential new plant is considered a possible investment. So we start with the lowest price, lowest cost one, and test whether or not, in a sequential decision rule, whether or not that one investment is going to be profitable from a full capital return point of view, long run marginal cost perspective. If it's going to be profitable after taking into account its effect on wholesale prices. If that plant is if that plant is profitable, then one moves to the next plant and considers whether or not the combination of those two plants, the combination of their effects on price suppression, would mean that those two plants are profitable or not, and so on until you get to the nth number of possible investments, if all are actually profitable. It's a fairly stringent rule in some respects, but it's a straightforward rule in that it avoids any possibility that a plant that's investing won't make a return. And when I say it's fairly stringent, I mean it overlooks the fact that in reality, unexpected events mean that in fact investors don't make target returns, that they do invest, and the prices do sink lower than they anticipated. But then on the other hand, I guess there's investors maybe to a degree what we might perceive to be, they might be risk averse in some sense from a sort of simplified perspective, but they might just be considering things like option values, which would support the use of this kind of stringent rule, which would push people to only invest if they're going to be covering their long run marginal costs more or less straight away. So the end result of essentially having this tighter rule is that we end up with substantially less investment in the modelling. So the 2019 CBA had 1 to 1.5 gigawatts of generation investment, and that falls substantially down to around 800 to 900 megawatts in the revised numbers. There's slightly more investment under the baseline when you count each megawatt in every year equally of investment. On a present valued basis, investment is higher under the proposal. That is to say, you're getting more investment occurring earlier. And some of that 883 megawatts of generation investment under the baseline is occurring right towards the end of the horizon. And because the model, just to say the generation investment in the model is path dependent, you get a degree of cycle, different timing and investment. So the extent to which it's larger in the baseline right at the end of the period is not necessarily indicative of a persistent result, but rather a potential timing issue. So when I say generation investment is path dependent, it's important to note that the modelling is not based on a long run equilibrium framework. So it's about sequences of investments and sequences of actions. So it has timing in it. And that timing of investment sort of flows through much of the results into the CBA. And not just the timing of generation investment, but the timing of cost changes, the timing of, battery investment, for example. So given we're not in an equilibrium framework or a long run equilibrium framework in the analysis, means the timing of investment is going to depend on the timing of changes in wholesale prices, timing of changes in demand, timing of changes in generation costs, and of course each of those things then hinges back on the timing of investment. So you've got a full system representation in which these things are sequentially interacting over time and then produce this path dependency. So in terms of that bringing forward of investment that occurs under the proposal, we've got a chart in this slide which shows the average of results across a range of scenarios. These timing and path dependency effects mean that the actual investment timing differs across different scenarios, but the persistent finding is that under the proposal, investment comes in a little bit quicker. The average helps to clarify that effect. So The reason that generation investment's coming forward is a couple of things. One is you get an increase in demand at peak, and that increases the profitability of investment in generation. Okay, all other things being equal, an additional unit of demand into peak is more profitable for generation investment. The other effect is that a HEMI charge in the baseline is reducing the profitability of investment in generation in the South Island. So we've got the example here in the table, which you can see if you sort of track through it, that you're getting investment in the generation in the South Island is generally higher under the proposal and also being brought forward. So another way to look at this is that rates of market entry are being constrained by suppressed peak demand and by higher costs being placed on generation under the baseline. So there are some questions that were raised in submissions also around how we should treat the costs of generation investment, whether they should be an explicit line item in the CBA, and then similarly why battery investment costs were treated differently. So on the first one, our view is that generation investment costs in and of themselves are captured in wholesale electricity prices, and conducting a calculation of the sum total of capital and operating expenditure over time would be double counting. So to be clear, there are two mutually exclusive ways that you can go about measuring supply costs. So one is to measure changes in investment and operating costs, just appropriately discounted and so forth, and adjusted for terminal value, the value of assets at the end of the period. And another is to use output prices and quantities. So to look at things like revenue. So there's a couple of reasons why one would focus on prices over investment and operating costs. I think the principal one is that output prices have the advantage of incorporating interactions between consumer willingness to pay and supply costs, okay, rather than taking a purely supply side view. Now this turns out to be particularly valuable in a world in which there are, where you've got a good, a product, a service for which the capital that serves that service has multiple uses across different times of use. Electricity is not a product that is homogeneous across all the times that it's used, but has differing value. And so it's much more appropriate to consider this output price interaction with consumers than just to focus on that pure capital cost element. So in the case of the battery costs, we don't take this price-based effect. We use a capital cost measurement of the difference between battery investment under the proposal and under the baseline. So the critical thing is that this difference that we get in investments between the proposal and the baseline is that it's due to the removal of a non-market price. Okay, so in this analysis, okay, so that's the RCPD charge. That provides the incentive for battery investment in the baseline. Because the RCPD charge is not a market determined price, it's inappropriate for us to rely on market prices to measure the benefits of avoided battery investment. Another issue that's wrapped up very much in the generation investment question is whether or not there were wealth transfers from generators to consumers encapsulated in the CBA. I think part of the concern that people expressed around this particular issue reflected some of the things, some of the criticisms, or was a result of the criticisms and issues raised in terms of potential excessive generation investment. With this tighter investment rule and generation investment, this issue is certainly, in terms of the way some people framed it in submissions, is much less of a, would have been much less of a consideration. But people also said, I think, more broadly, that the CBA is in some sense invalid because it counts these changes in prices, which are wealth transfers between producers and consumers, and counts them as benefits. They've also, I think, people or some submissions raised a question about whether or not the framework that we used was consistent, because it treats changes in wholesale electricity prices as benefits, but at the same time treats interconnection charges as transfers. And I mean, quite simply, I think that the view is in response that first, that the CBA is not treating a transfer as a benefit when it looks at electricity prices. So essentially is saying that lower electricity prices on average are from efficiency gains, which are bona fide benefits. And we need to be clear too that the prices are not always lower, but just to say not on at every point in time. So we're taking the balance of effects here. That is to say, not always lower under the proposal relative to the baseline. Okay, so we get periods, particularly early in the analysis, of rising wholesale electricity prices, but the key dynamic process and efficiency gain comes through those higher prices bringing forward generation investment, which in turn reduces wholesale electricity prices. And so it's that dynamic that we're capturing, and that creates benefits, and that's essentially the efficiency aspect. It is true at the same time that existing generators, as new generation investment comes in, may lose profits or even market share. That is not a cost, but an efficiency gain. And the best way to conceptualize this, trying to keep things reasonably high level, is to consider that changes in investment represent an increase in market entry or competition in a market. Okay, and the result of this is that producers, when they're coming into the market, are providing greater value. And in this case, value is being measured in terms of costs of supply and consumer willingness to pay for supply, intersection of the two. Okay, now the reason we don't treat interconnection charges as, we do treat interconnection charges as a transfer, is that there's no similar market determined dynamic efficiency gain in play. Okay, so the first order effect of interconnection charges is purely to impose a cost, but that the money that's raised through the interconnection charges has to be raised somehow. All other things being equal, so the value of grid services being equal, that money's got to be raised in return for those grid services that people are enjoying. So to the extent that the revenue requirement is fixed, you can't treat them, even if they are on the first order effect as a cost, you can't treat them as a cost, you've got to treat them as a transfer because somebody's got to pay that money. And so in order to understand the efficiency effects of any redistribution of revenue, we need to net those transfers off. And there is an alternative to taking that approach of netting off the transfers, and that would be to use a total surplus measure of welfare change. Total surplus measure of welfare change will automatically net out these transfers, at least particularly in the case where we're moving interconnection charges from generation to load. So that's one approach, but depending on the policy that you're investigating and trying to evaluate the costs and benefits of, focusing on total surplus can have fishhooks. Certainly true in this case, which is that if there are distortions that are impeding market entry, then you can get a change in transmission pricing that can result in an increase in total surplus, even as consumer welfare declines. So consumers aren't necessarily better off overall and at the long run. On balance, producers might just be better off. This, creates certainly an issue for any policy that's trying to deliver long-term benefits to consumers. So that's, it's not to say that total surplus isn't a valuable indicator of changes in market efficiency, but if you're interested in long-term benefits to consumers, then as a decision criterion, total surplus isn't without potential problems, so that at a minimum you can't take it entirely on face value without carefully scrutinizing the components of it. And the alternative is to just consider consumer surplus gains in general, and to consider the efficiency gains after you've deducted the direct costs of transfers, the redistribution of the interconnection charges. This slide we've got here on long-run energy price effects probably belabors the point a little bit on wealth transfers, but it's potentially helpful. The key point of the diagram is simply to illustrate how efficiency gains result from lower prices, and that delivers benefits to consumers. So the figure basically shows how investment changes can lead to, how investment can change the long-run supply curve that leads to a mixture of efficiency gains and changes in allocation of surplus, that is to say gains from trade. The mechanics of the CBA itself are, of course, more complicated than this, because we're dealing with demand for distinct services, electricity by time of use, and we're analysing changes in demand and investment over time. But I think that this particular static picture does serve to illustrate the extent to which changes in prices can reflect welfare gains.
Right. We've got a bunch of questions as a result of this segment, so I'll take them in turn as much as possible. First one from John Curley. The investment stack does not seem to include new geothermal options, for example, Tauhara, which appear to have long-run marginal costs below the projects which are built. How is this consistent with the new investment rule?
Excuse me while I pause just to wonder if I can recollect the exact numbers. It's not, so it does depend on which particular scenario you have a look at as to whether or not Tauhara is invested. And one of the, and I guess it would depend on whether I'm referring to which scenario and baseline and so on. So it's a bit hard to be precise again with the constraints of screens here. But it is the case that returns to investing in the model, returns to investing in geothermal at Whakamaru is depressed by nodal pricing differentials through the modelling. So over time, Whakamaru has negative nodal price differentials. So locational prices are down at Whakamaru, essentially excess generation. Now, one might wonder about that particular result on account of the fact that a project-specific detailed analysis of the profitability of that particular investment might give a different result. And it is absolutely true that the aggregation of generation and load into the backbone nodes that we use in the model is going to mean that you wouldn't use this model to necessarily determine the investment prospects of a particular real-world investment in 10 years' time, for example. And that's the mechanics essentially there are nonetheless the case that you have large amounts of generation at a node, then the model is going to be depicting a negative nodal price differential that will basically suppress the profitability of investment at that node.
That gets us to actually nicely to another question by John Cully, which says, can you explain how the increased costs of losses and constraints across the DC are accounted for when New South Island options are built ahead of North Island options?
The model doesn't explicitly consider the DC. It does consider persistent nodal price differentials. So to the extent that returns are lower in the South Island, other things being equal, then it's a reasonable hurdle to get over to bring that generation forward, other things being equal, unless it happens to be lower cost in the build and operation. So those things are taken into account, but there isn't an explicit depiction of any incremental effect on the DC, if any.
There's a question here from Daniel Young. Can you explain how you have calculated the LRMC of new generation investment? The values you use do not appear to be the same as the MB data you are drawing from.
So excuse me, it's a while since the MB data was constructed. It would be, so I can't speak to what MB did because they didn't publish their calculation of LRMC. This is certainly why, or have access to the calculations when asked. So it's, new ones did have to be constructed that were consistent with the numbers that were in the GEM model. I can assume that, assuming we're talking about the same numbers, it may or may not be. It may be that the MB numbers that were published, LRMC numbers, aren't necessarily exactly the same as the ones that were in the GEM model, at least in terms of the capital costs and so forth. It's also the case that we did update those numbers for changes in fuel costs, for changes in carbon prices and so forth, and inflation. So there were various adjustments made to the costs that were used in GEM modeling by MB in 2016 and 2017. As to any differences with, say, the published long-run marginal cost numbers that they have in their tools and on the website from the 2017 edges, I can't speak to that in any detail.
A question from Hayden Green. Have you tested how well this new generation investment rule performs at predicting historical market outcomes? For example, if you ran the model as at 2000 Would it predict accurately the generation that was actually built between 2000 and 2020?
No, we haven't done that, would be the simple answer.
There is this, sorry, just checking I was unmuted. David Buckrell, there's a 6 to 7 year lag between the TPM changes modeled to commence 2022 and when the benefits from these changes really start to be seen, 2028, 29. You would never get an investment decision through a board if the investment case depended on benefits only really starting to be seen 6 or 7 years after the investment. The board wouldn't have confidence that the benefits, even if modeled to be substantial, would in fact occur. How would you respond to critique of this type?
I'm not 100% sure that that's a, I mean, it's not a generation investment question, but certainly
I think you're right. To the well, perhaps you can ask David if it is a generation investment question or a more general question. Could you arrange for that, Justin? Unmute David Buckrell.
It's just a question on the whole CBA. Most of the benefits relate to more efficient grid use. So I don't know if this is the right time to ask that question, but it's just a general question I have of the CBA as a whole.
All right, thanks for that clarification.
Yeah. You want to? Should we discuss?
Might as well. Yeah, might as well answer.
Sorry.
You might as well give it a shot answering now, given that the question is out there.
Yeah. Okay. It's an interesting one, I think, because unfortunately it probably gets very quickly into philosophical issues. What perhaps we can park those and just say that. Just make the observation that public decisions around regulation, law, institutions, infrastructure, investment, they too tend to have a lower marginal rate of time preference. They do tend to be concerned with longer run effects and benefits that might accrue over a 10-year period or a 20-year period. And I doubt very much in this particular situation we're going to resolve exactly what the right horizon is, but it's very much the nature of regulatory decisions and public investments that they tend to take the longer view. And some, when I say it's philosophical, some would argue that the commercial private view is a little bit short-sighted. Some would, while others would argue that the public view is rather long-sighted. I should say, granted, there is uncertainty, and if the question is also about how does one think about the uncertainty of the benefits that can be obtained, I think on the one hand, it's something for the decision makers taking into account a range of related information and views from people, including CBAs, which carry uncertainty, and essentially trying to judge whether on the balance of likely outcomes, it's going to be net beneficial overall, or a net cost. And it's ultimately all you can do. Probably also worth observing that when one pulls the trigger on considering change, one doesn't do it overnight. And the change itself doesn't happen straight away. So if one waited till one saw, if one was in a position in which the benefits might not accrue for 5 or 6 years or 7, if one actually stepped back and then tried to restart the consideration process down the track, you'd be apt to miss the mark and have benefits foregone, and that would come at a cost as well. There are many different sides to that particular, the issue of uncertainty, which is everywhere.
Thank you. There's a couple of questions related to total cost of generation and whether how that would fall and if it was estimated. I'll read out Daniel Young's question, but Hayden Green had a similar question. You have assumed that assessing benefits by reference to changes in prices is conceptually similar to assessing benefits by reference to changes in cost. Have you sought to test this assumption by calculating the change in wholesale market costs, which is an output of the modeling?
No, we've looked at costs, but not in any, we haven't sort of done the counter calculation. But I think there's maybe a little misunderstanding in the question. So when the use of prices is not because prices are simply a proxy for costs, and then if we just measured the costs, we'd know the right answer. It's actually because just measuring costs doesn't give you the full answer. So this is to say, no, we haven't gone to check whether or not price-based measure equals the cost-based measure, because we don't think the cost-based measure is the right measure.
It's a question from Marianne Mitchell. In the table and chart you had on one slide, the table lists megawatts of new generation projects, and the graph shows cumulative increase in peak megawatts. What assumption is made about the contribution of the new wind projects to peak megawatts?
Unfortunately, I can't answer that number precisely. I mean, I can say the mechanics of it. That's obviously different plant actually has different wind projects have different degrees of contribution to peak. I think offhand, I won't say what the number, exactly what the number is, because I'm bound to be wrong. But it might be something like, 50%. The slight discount on wind contribution to peak, if memory serves, based on looking at the actual running of running of wind at peak. So empirically, for the peak periods defined in the modelling, they're contributing slightly less at peak than they do on average. So slightly lower than average output from wind farms during our predefined peak periods.
Okay, thank you. There are a number of other questions, but according to our timetable, we should now have a brief break, which we will take. Can I just assure people those questions aren't lost? We'll look at them, answer them in session if possible. But in the meantime, let's have a break for 10 minutes, get back at 11:15, and we'll talk again then.